The EV industry is getting a lot of attention over the past week or two because the Biden administration said that they're going to put 100% tariffs on the import of Chinese electric vehicles. This should protect a lot of those US manufacturers like Tesla, like Rivian, like Lucid from a lot of competition that is coming from China. The thought here is that Chinese companies are subsidizing their electric vehicle industry. They're selling those vehicles below what their economic costs are. And so we need to protect US companies, US jobs, and that's exactly what's going on. The problem is the reality for these kinds of tariffs is often not what a lot of investors think. The reaction from the market has been to push a lot of these stocks higher because tariffs are going to be helpful. But it doesn't fundamentally change what's going on in the electric vehicle space. And the precedent that we've seen over the past decade and a half, particularly in both wind and solar, is that when you start having to go to protectionist measures like this, companies will both find their way around tariffs, and the fundamental struggles that you have within the US market aren't fundamentally going to change because of tariffs on imported vehicles. So I'm going to dig through exactly what we found out over the last couple of weeks and give a little bit of historic precedent to how tariffs impacted the solar industry, because I see a lot of parallels between solar in the mid-2010s and the electric vehicle industry today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's look at what we found out over the past week or two. This is from the White House, and you can see here the tariff rate on electric vehicles under Section 301 will increase from 25% to 100% in 2024. I believe this is going to go into effect in August, with extensive subsidies and non-market practices leading to substantial risks of overcapacity. Chinese EVs grew by 70% from 2022 to 2023, jeopardizing productive investments elsewhere. Basically saying that China's EV market is growing too quickly. There's a price war going on there, and we don't want to be where you dump products. That's what some of these 301 tariffs are, as anti-dumping tariffs. So this is the same exact tariff that was used in the solar industry. Now they're implementing it for the electric vehicle industry. The same thing is happening with batteries, components, and parts. Depending on the exact product, the tariff will be different rates from 7.5% to 25%. This is one of those kind of strange situations where a lot of US manufacturers are actually using batteries that are produced in China, including Tesla. Tesla actually discloses the percentage of vehicles that was produced in China, and it's actually a pretty high percentage in a lot of their vehicles. So this is going to be something that supply chains may need to change, but they're not putting as high a tariffs on batteries and some of these components because a lot of those US manufacturers are actually using these products, and there's not quite the same supply chain in the US. So this is what we're seeing with tariffs today, and the reaction from the market has been pretty strong. You can see that Rivian stock is up 18.1% over the past month. Lucid is up 9% over the past month, despite everything that they're going through. Tesla also up 10.6%, despite the fact that China is actually a really important market for Tesla. They produce a lot of their vehicles there. So if there is protections coming from products that are produced in China that can't necessarily be sold in the US or Europe, that's potentially a negative for Tesla. But like I said, the reaction was really strong. But let's look at a little bit of context on what happened when solar protections were put in place in the solar industry. Now, there were tariffs put in place during the Obama administration, so the mid-2010s, that were intended to protect the US manufacturing industry of solar panels. There's a lot of different components that go into this, but First Solar makes a little bit different technology with a thin film solar panel. So they've always been the biggest beneficiary of solar tariffs, but there was also companies like SunPower who were making solar panels at that period of time. They were importing cells and assembling some of those cells in other parts of Asia. Some of them were assembled in the US. They even bought a manufacturing plant in the US trying to get around these tariffs. But the impact on investors was not necessarily what you might think. A lot of those tariffs went in place in this time frame, in the mid-2010s. And you can see that First Solar really didn't go much of anywhere until 2020. This was when a lot of renewable energy stocks kind of went crazy. And then you have the Biden administration passing the Inflation Reduction Act, which was actually a huge benefit, a huge subsidy for First Solar, really driving their net income. That's why you see the rise in their stock price over the past couple of years. But for years, despite being the industry leader, First Solar stock essentially went nowhere despite tariffs. SunPower, the story was even worse. A lot of those tariffs were put in place right around this range. SunPower stock was trading for $18, $20 per share. You can see that over the next few years, the stock fell to $4 or $5 per share and just didn't go anywhere until, again, the pandemic came along, and then you get shares popping. But it didn't fundamentally change their competitive position. So what happened and why did these tariffs not work? This is something that I think we'll see happen again. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. What a lot of solar manufacturers ultimately did is they moved their manufacturing facilities, or at least pieces of their manufacturing facilities, to other countries. So sometimes it was they would move assembly to other parts of Southeast Asia. That was if there was tariffs on something like solar modules. Then there was tariffs put on cells. So then you move your cell production to a different part of Southeast Asia. Some of them moved facilities to Mexico. But tariffs are like whack-a-mole in these industries because manufacturers will just simply move to where things are most economical. And I think that's the same thing that's going to happen in the battery industry and in the electric vehicle industry. These tariffs are intended to basically insulate US manufacturers, but it's not going to be particularly effective because there's going to be loopholes that all these companies are going to be able to use. One of the things that we have already heard is that presidential candidate Trump, former President Trump, has said that he wants to put a 200% tariff on EVs coming on vehicles coming from Mexico. Well, that sounds like a great idea until you realize that a lot of the Detroit automakers are actually assembling a lot of their vehicles in Mexico. So they're using the lower cost labor in Mexico to be able to provide more affordable vehicles in the US. There's no reason that Chinese companies can't do the exact same thing. So the fundamental dynamic here is that competition is increasing in the electric vehicle space. We need to have an industry where demand exceeds supply. And right now, supply is exceeding demand. That's why we're seeing a price war in China. That's why we're seeing Tesla cut prices. Rivian is now cutting prices on some of its vehicles. We've seen GM and Ford lower the price of some of their electric vehicles. So this is just a fundamental challenge all around for the industry. And I think for the companies that are not profitable today, so the Rivians, the Lucids, they're going to have a very hard time getting to profitability in a market where there's an abundance of electric vehicles and not an abundance of demand. And this is just fundamentally where we are today. The solar industry went through this in peaks and valleys over the last decade and a half. And whether it was US manufacturers or Chinese manufacturers, when there was an overabundance of supply, a lot of companies ended up going bankrupt. That will ultimately happen again. It's just the reality of the market in a manufacturing business like this. Not every company will survive. I think we'll see the same dynamic play out, and I don't see any end right now to the competition. So investors who are looking at EV stocks should really focus on companies with really strong balance sheets, with positive net income, positive free cash flow. There's not a lot of names out there, and I think actually the best place from a risk-reward perspective is actually some of the legacy automakers who may be able to scoop up some of these electric vehicle companies that have popped up at a discount if they run into financial trouble. But don't think that tariffs are going to save the industry. I think this is really the thing that I want to get across to investors today is that stocks popped when a lot of these tariffs were announced for solar companies and solar components in the mid 2010s. It didn't help their fundamentals because competition always finds a way around these tariffs. And so if you take anything from this video, I hope you can take something from that dynamic. But let me know what you think about EV stocks today. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.